Folks, it's that time of the year when I get to embark on a mini-series favorite of mine. By now you probably realize that I do tons of research in the stock market on a weekly basis. And if you're a subscriber to my Stock Investors Edge community, you get to see this in detail. At the end of the year, I like to look at certain setups and top stocks I'm looking to buy heading into a new year. There's plenty of investors that are out there looking to reshuffle or rebalance their portfolio. So this mini-series we're about to embark on is going to cover videos such as 10 top dividend stocks for 2025, top 5 ETFs for 2025, and the focus of today's video is going to be 10 top growth stocks for 2025. Now, when you go through these 10 positions we're going to look at here today, you may see that some of them pay dividends, but their sole focus is primarily on growth. So before we begin, show your appreciation for the research and for this video by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And I would like to thank YSheets for sponsoring today's video. When it comes to looking for growth stocks to include in this video, ones that I expect to have large amounts of growth heading into 2025 and beyond, research is key. But the problem is the fact that for many, the research aspect of things can take up so much time for every company that you analyze to copy and paste the data like you see here in this video. And to make matters worse, oftentimes investors are going through hundreds of companies just to find that one investment. To eliminate that hassle, that's where YSheets comes in, which is an add-on to both Microsoft Excel and Google Sheets, and it will automatically retrieve the data for you. Whether it's getting all the data you want for a list of stocks like this, or building custom models like this where you can change the ticker and everything updates on its own. Or if you want to dive deep into the financials of a particular company, YSheets can do that for you. It is a fascinating tool, and right now for viewers of this channel, when you use code MARK at checkout, they will give you $15 off their subscription. Check out the link down in the description below. All right, let's jump back into the nitty-gritty, taking a look at 10 top growth stocks to consider for 2025. And I have to admit, this year it took me a lot longer to compile this list. Why? Because we've had back-to-back years in which the S&P 500 has climbed 20% or higher. This has only happened a few other times. And during those years, what happened in the subsequent year? We saw a stock market crash and we saw another 20% climb in the market. So it's anyone's guess on what is going to happen in 2025, but I am optimistic. And also, this list isn't intended to be a shot in the dark, highly speculative type names, so know that going in. All right, let's jump things off by starting with stock number 1, which is going to be Nvidia, stock ticker NVDA. Let's just get this one right out of the way. This has been one of the best performing stocks, not just last year, but in the prior year to that as well. Since the end of 2022, shares of Nvidia are up an impressive 818%. Take that in for a second. Wow. And although the comps are getting more and more difficult year in and year out, this company continues to defy all odds. The company currently has a market cap of $3.4 trillion, making it the single most valuable company here in the US. They operate out of the technology sector, and over the past 12 months, shares of Nvidia have climbed 180%. For months now, if not years, investors have been trying to call a top with Nvidia. However, never be scared to buy a stock at a 52-week high. Let valuation and technicals guide your path. I said this back when the stock was at $800. It had just climbed from $500, and it was trading at, yet again, another 52-week high. However, what I mentioned was that when the stock was trading at $800, from a valuation perspective, it was technically cheaper than it was back when it was trading at $500, which gave me confidence to say this is a stock that can continue to climb higher, even though it's up 100, 200%. Analysts are looking for the company to generate earnings per share growth of 50% the next 12 months, followed by 25% the following year. Using these figures, this gives the stock a forward price to earnings multiple of 31 times. And with that growth rate, a PEG ratio of just 0.8, which is extremely intriguing. So again, you might be thinking this stock continues to multiply and it's trading over 30 times. However, The growth that you're getting and expected to get for this company, not just next year, but the year after that, is still quite intriguing from a valuation perspective. Analysts continue to remain quite bullish on the stock, rating it a strong buy with an average 12-month price target of $176 per share, implying more than 30% upside from current levels. And that leads us to growth stock number 2, which is going to be Advanced Micro Devices, stock ticker AMD. Let's go from one semiconductor company to another and keep the theme going. But when it comes to AMD, for years they have lived in the shadow of Nvidia, and rightfully so. And when you look at the charts, AMD has been in a downtrend pretty much since early March of this year. Not something we like to see from a technical perspective. However, from a fundamental perspective, things look quite cheap. And what's the old saying? Be greedy when others are fearful. AMD currently trades with a market cap of $212 billion, operating out of the technology sector, and over the past 12 months, shares are down 8%. And as you can see, the results for AMD have been drastically different than that of Nvidia, which we just looked at. And as I mentioned in previous videos before when talking and touting AMD, it's the fact that I don't need AMD to catch Nvidia. I just need them to close the gap a little bit. That would be huge for the success of AMD and its shareholders moving forward. When it comes to AMD, they are involved in a lot of exciting areas, whether we're talking about AI, supercomputers, cloud, data centers, self-driving, gaming, and the list goes on. AMD will be launching a brand new GPU here in early 2025, something that investors are hoping is going to turn things around for this particular company. It's not a leadership issue because this company has a fantastic leader in Lisa Su at the top of the helm. Looking at the forward estimates, revenues are supposed to ramp back up the next 2 years, averaging roughly 25% in each year. As for earnings, the numbers are even higher, with growth expected to surpass 50% next year, with the company poised to earn $5.11 in EPS. Using these figures, that gives the company a forward PE multiple of just 25.5 times, which is pretty close to a market multiple, and it gives the company a PEG ratio of around 0.5, which is incredibly cheap. On a price to free cash flow basis, shares also look cheap here at 39.5 times, which is outside of the 2022 crash. This is the cheapest you've been able to add shares since 2018. Analysts continue to remain quite bullish on the stock, rating it a moderate buy with an average 12-month price target of $184, implying a monster 45% upside from current levels. And that leads us to growth stock number 3, which is going to be Amazon, stock ticker AMZN. Amazon is already one of my largest positions in my portfolio, and it's probably my favorite stock on our list of 10 here today. And if you've watched my videos in the past, you know that I love investing in companies that have a diversified revenue stream. So when we're talking about Amazon, we're not just talking about e-commerce. We're talking about cloud and digital subscriptions. We're talking about advertising, physical stores, and the list goes on. And the other thing garnering a lot of attention for Amazon has been their building of their internal chips, which isn't something new. Most mega cap companies are doing this. Apple builds their own internal chips. Alphabet builds their own internal chips. Microsoft builds their own internal chips. And yes, Amazon is building their own internal chips. So while this build out is still years away, this is definitely something to start thinking about in the long term for Nvidia and AMD shareholders as well. Amazon currently trades with a market cap of $2.4 trillion, making it one of the largest companies in the S&P 500 today. It operates out of the consumer discretionary sector. And over the past 12 months, shares are up 53%, making for a fantastic year. Outside of building their own chips, Amazon continues to fire on all cylinders. E-commerce continues to do well. AWS is the largest cloud provider. But one thing that this company doesn't get enough attention for and appreciation is advertising. Amazon is the third largest digital advertiser behind the likes of Alphabet and Meta. There's a lot to like about Amazon heading into 2025, but the stock has been on a tear, climbing 10% just in the past month alone. So with this one, I'm going to be a little bit more patient. Analysts are looking for the company to have 10% revenue growth the next few years, topping $700 billion in 2025. In terms of earnings, analysts are looking for the company to generate EPS of $6.17 next year, which would equate to 20% year-over-year growth. Using those figures, this gives the company a forward PE multiple of 37.1 times and a PEG ratio of 1.7. I do prefer to see that PEG below 1.5 at the very least for growth stocks. When looking at the charts and scoping out a preferred buy price, I'm probably going to be a bit more patient here, as I mentioned, to see if we can pick up shares closer to that $200 per share or lower, as this would give the stock a forward PE of 32 times and a PEG ratio of 1.5. So that would be the price target to start nibbling again for me. Analysts agree that the stock has ran a little too much of late, limiting the near-term upside, but they still rate the stock a buy with an average 12-month price target of $242, indicating a nearly 10% growth from these levels. And that leads us to growth stock number 4, which is going to be Uber Technologies, stock ticker UBER. When it comes to shares of Uber, they have been in a bit of a rut of late, ever since the announcement of robotaxis. Now, this isn't anything new, but at the same time, the stock down as much as it is, robotaxis are going to be something to consider, absolutely. But I don't believe they're that close to making an impact on the business of Uber. Right now, Waymo is the largest service, but this is only offered in a handful of cities, and there are only 700 Waymo cars in service today. Uber has nearly 8 million drivers today. So we do not want to discount robotaxis by any means, but we also want to be realistic. Uber currently trades at a market cap of $129 billion, and it operates out of the industrial sector. Over the past 12 months, shares are down 3%, with much of those selling pressures, as I mentioned, coming since mid-October, falling 30%. But I believe the move lower is vastly overdone, and by the end of 2025, this could be one of the largest gainers in my portfolio. Analysts are looking for the company to maintain a 15% growth rate for each of the next few years when it comes to revenues, topping $50 billion in 2025. In terms of earnings, analysts are looking for the company to generate EPS of $2.31 in 2025, which would equate to year-over-year growth of 22.5%. And they're looking for more than 40% growth the following year. Using those figures, this gives the company a forward PE multiple of 26.5 times and a PEG value of just 0.8, making shares of Uber look very intriguing. I recently opened a cash-secured put at a $55 strike price when it comes to Uber, and this is how I enter into a lot of positions these days, utilizing stock options for stocks I want to buy at prices I want to buy them at, and I'm generating income on a weekly and monthly basis. You can check out my option plays by subscribing to the Options Edge Plus within my Stock Investors Edge community. You could find that link down in the description below. When it comes to analysts and Uber, they are very upbeat on the stock as they rate it a strong buy with an average 12-month price target of $94 per share, implying more than 55% upside from current levels. And that brings us to our 5th growth stock, which is going to be Alphabet, stock ticker GOOGL. When it comes to Alphabet, they are the largest within the communication services sector. And shareholders of Google have been on a roller coaster in 2024. Trust me, I know, because this is my largest single stock position within my portfolio. Ever since mid-November, reports came out about a DOJ case involving Google where they wanted the company to break up its Chrome business. At the time, I put out a video and even talked about it during my live show, how this was more of a shot in the dark, wishful thinking when it comes to the DOJ. A DOJ that has a terrible track record when it comes to these types of cases. I started buying the dip on those reports when Google was trading in the 160s. And look at where we're at now. Alphabet trading at a new fresh 52-week highs. Don't let overreactions disrail your investing. Don't let emotions creep in. Emotional investing is always a losing strategy. When it comes to Alphabet, they currently trade at a market cap of $2.4 trillion. And as I mentioned, they operate out of the communication services sector. Over the past 12 months, shares of Google have increased 43%. Alphabet is another company that is well diversified, very similar to the likes of Amazon. They have Google Search, they have YouTube. Those two alone are the 2 largest search engines in the world today. On top of that, they have cloud. They have AI, something they stumbled out of the gate, but they've been really gaining some steam with. And this is something that they didn't go out and purchase. They have built this on their own. and it's starting to make great strides. Analysts are looking for the company to maintain a 12% growth rate for revenues each of the next few years, inching closer to $400 billion in revenues in 2025. In terms of earnings, analysts are looking for the company to generate EPS of $8.95 per share next year, which would equate to year-over-year growth of 12.25% this year, and they are looking for more than 14% growth the following year. Using those figures, this gives the company a forward PE multiple of 21.4 times and a PEG value of 1.6. Analysts continue to like the stock as they rate it a strong buy, with an average 12-month price target of 209, implying more than 10% upside from current levels. Before we move on to the back half of this list, let me take a moment to tell you about the Stock Investor's Edge. This is my premier investing community. If you are serious about investing and building not only wealth for today, but building generational wealth, this is the community that you want to be a part of. Whether we're talking about growth stocks, dividend stocks, or options, we have it for you. Definitely check out the link and become a member today. Now we are going to move on to the back half of the list, beginning with growth stock number 6, which is going to be ASML. Stock ticker ASML. We already made it abundantly clear that AI is here, and I believe AI is still in the early innings. But regardless of whether we're talking about chip makers need one thing. They need the best equipment to make these high advanced chips. What is the best company out there in terms of equipment makers for AI chips? It's going to be ASML. Now, they have competition with the likes of Lam Research as well as KLA Corp, but the largest in the space, by a wide margin, is ASML. And not only are they the largest, but I believe its valuation is the most compelling. The company currently has a market cap of $281 billion, operating out of the technology sector, and over the past 12 months, shares have really gone nowhere. ASML shares fell rather hard after the company reported its Q3 earnings that also saw its forward 2025 guidance come in rather weak. Since topping out in mid-July, shares of ASML have fell 35%, but they have found a good amount of support around that $700 per share level. So why all of the weakness, you might ask? Well, the results of CapEx timing was a little different, as well as concerns around China. We have a new administration coming into power here at the start of 2025, Trump 2.0, and there's one thing evident is tariffs are going to be there. And this business, ASML, in the past has had large exposure to China, something they're reducing from the likes of 50% down to 20% in 2025. AI investment is happening all over the globe. Japan has plans to invest $1.3 billion in a local semiconductor company known as Rapidus. And who else is involved in that? ASML. CapEx, as it relates to AI, is not slowing. And you see that in the results. Not only are the results of the hyperscalers, but also in their forward guidance. In fact, Taiwan Semi CFO said he expects CapEx spending in 2025 to surpass the surge we saw in 2024. And on top of that, more companies are looking to build new factories domestically, and all of that bodes well for ASML. The China risks are known, but a lot of that seems to be priced in given the fact that shares have fell 30%, something I think is a bit overdone. Analysts are looking for the company to grow its revenues by 15 and 14% the next few years. Earnings are expected to grow 22% next year to $24.58 per share, followed by 26% the following year. Using those figures, this gives the company a forward PE multiple of 29 times flat and a PEG value of 1.3. Analysts also think the sell-off was too much as they rate the stock a moderate buy with an average 12-month price target of $880 per share, implying more than 20% upside from current levels. And that leads us to growth stock number 7, which is Micron Technologies, stock ticker MU. Let's continue on with the AI theme, talking about yet another semiconductor company, but one that doesn't get as much attention as the likes of AMD or even the likes of Nvidia gets. The company is due to report its latest earnings report after this video is published. So if you're not yet in this stock, it might be beneficial to wait and see updated results before jumping in. Currently, shares of Micron trade at a market cap of $108 billion. They trade out of the technology sector, and over the past 12 months, shares are up nearly 30%. There's a lot to like when it comes to Micron. Obviously, they play in the AI space, but the results have backed it up. We have seen revenue growth of more than 90% year over year. And they look cheap from a valuation perspective. When it comes to AI, we talk about AI stocks all the time, but the great thing is that there's a number of different ways to play AI. You could play the chip manufacturers. You could play the chip equipment makers like we just saw with ASML. You could take a real estate approach and invest in data centers. Or with Micron, they take a different approach and they're more in memory. And when it comes to Micron, there's an enormous AI server demand, which falls right into the lap of Micron, evidenced by their strong growth and upbeat guidance for 2025. So why is the stock down 35% from their 52-week high? There's a few reasons. Increased competition, concerns about China, concerns about tariffs with the new Trump administration come in. But all of these things to me are short-term headwinds. The results are still there, the demand is still there, and the value is there for investors. Analysts are looking for the company to generate more than 50% top-line revenue growth this fiscal year, followed by 22% growth the following year. When it comes to earnings, analysts are expecting earnings to grow nearly 6x this fiscal year and nearly 50% the following year in 2026. Using those figures, we are talking about a company in Micron trading at a forward PE multiple of just 11.1 times. That is half the S&P 500. And then you're looking at single digits when looking at 2026 figures. That is wild, and this might just be the steal of the list. Analysts are also upbeat on the stock, rating it a strong buy with an average 12-month price target of $153, implying nearly 50% upside from current levels. And that leads us to growth stock number 8, which is going to be Caesars Entertainment, stock ticker CZR. When it comes to Caesars, they are one of the premier casino operators, not only on the Las Vegas Strip, but around the U.S. Some of those properties just in Las Vegas include the likes of Caesars Palace and Caesars Forum, Harrah's, Paris Las Vegas, Flamingo, the Link Hotel, and Planet Hollywood, just to name a few. The company also happens to be one of the top operators for the largest landlord on the Las Vegas Strip, which is that of Vici Properties, one of my favorite REITs to invest in. When it comes to Caesars, they currently have a market cap of $8 billion, making it one of the smaller companies on our list today, and they operate out of the consumer discretionary sector. However, over the past 12 months, shares are down more than 20%. Caesars Entertainment is a play on a growing economy. We need a stable and growing economy really for this company to perform well. And when it comes to gambling, particularly when you think about sports gambling, it's really been revolutionized over the past few years, taking much more of a digital approach. All of this is gaining more traction, which bodes well for a company like Caesars Entertainment. However, we do need a strong economy. If we fall into a recession, all bets are off, literally. Analysts are looking for the company to generate very little in terms of top-line growth at 4% next year and 3% the following year. However, earnings are where the growth is. After reporting negative earnings 4 of the past 5 years, the company is expected to generate EPS of $1.27 next year, which would be a huge shift from this year, followed by more than 60% growth on top of that in 2026. Using those figures, this gives the company a forward PE of 29.7 times. Analysts are also upbeat on the stock, rating it a strong buy, with an average 12-month price target of $53, implying more than 40% upside from current levels. And that leads us to growth stock number 9, which is SentinelOne, stock ticker S. And when it comes to SentinelOne, this is going to be our final technology stock on today's list. And for those of you unaware, SentinelOne operates as a cybersecurity firm, something that is very needed in today's economy. SentinelOne may not be one of the largest cybersecurity firms right now, but it's the one that's been catching my eye, and I'll talk more about that here in a second. But when it comes to cybersecurity in general, I believe this subsector can be larger than AI over the next few years. Just check out these stats right here. In 2023, roughly 50% of UK businesses experienced some sort of cyber attack. Data breaches cost businesses nearly $5 billion this year alone. The number of data compromises has skyrocketed in the past years, and that is not something that is necessarily going to slow down. SentinelOne currently has a market cap of nearly $8 billion, operating out of the technology sector. However, over the past 12 months, shares are down 8%. SentinelOne is unique in the fact that they blend both AI and cybersecurity together. You're getting the best of both worlds. And the best part for investors is the fact that they're taking market share. Out are the days of legacy cybersecurity options, and in is the likes of SentinelOne, which is the most innovative AI-powered cybersecurity firm on the market today. And the results back it up. Analysts are looking for the company to generate top-line revenue growth of about 25% growth each of the next few years, and earnings are expected to continue to grow sky high, with the company finally becoming profitable, and things tend to snowball from there in a good way. FY25 EPS is estimated to come in at 19 cents per share, which equates to a forward PE multiple of 123 times. By no means cheap. But you can see on this chart here, the growth expected over the next few years alone, which can continue. So when it comes to SentinelOne, this is going to be one of those more speculative plays and less focused on valuation. When it comes to analysts' expectations, they are also upbeat on the stock, rating it a moderate buy, with an average 12-month price target of $30, implying roughly 25% upside from current levels. And that leads us to our final growth stock, number 10, which is going to be Block Incorporated, stock ticker SQ. Block, formerly known as Square, is a fintech play. And with the new Trump 2.0 administration coming into power here at the start of 2025, what has been some of the talk? Less regulations. Which sector does that benefit? It's going to benefit the financials sector. In addition to that, the reasons I like Square or Block, whichever you want to call it, is this is a backdoor way to play crypto as well. Because when it comes to this particular company, they have more than 800 million worth of Bitcoin on their balance sheet today. And the company is led by former head of Twitter, Jack Dorsey. Block currently has a market cap of $58 billion, and as I mentioned, they operate out of the financial sector as a fintech company. And over the past 12 months, shares are up more than 30%. With a pro-crypto administration coming into power, that bodes extremely well for the likes of Block. Also, the revenue and earnings outside of crypto alone have been performing quite well and are expected to continue to perform quite well. This is a company that owns the likes of Cash App. This is a company that owns the likes of Square point of sale systems and Afterpay, which is a buy now, pay later options. If this sounds familiar in any way, shape, or form to PayPal, that's because it is. PayPal is their closest competitor. When it comes to Block and looking out into 2025, three major analyst firms out there named Block their top idea for 2025, including the likes of Bernstein's, who has a $120 per share price target on the stock, implying nearly 30% upside from current levels. Other reasons to be upbeat on the stock, not only less regulation, but also the fact that this is a company that has a lot of momentum. And if in fact they continue to grow at the pace they're expected to continue to grow at, that could include them being added to the S&P 500, which that right there would be another catalyst higher for shares of SQ. Analysts are looking for the company to generate top-line revenue growth of about 11% each of the next few years. Earnings growth has been much faster though, with the company becoming much more efficient and well-run. 2025 EPS is estimated to come in at $4.59 per share, indicating nearly 30% year-over-year growth, followed by 23% growth the following year. Based on these figures, that gives shares of Block a forward PE of just 20.5 times and a PEG ratio of 0.7, which makes shares look quite intriguing. When looking at analyst projections here, you can see they're a bit misleading, given the fact that there's one single sell rating by Morgan Stanley with a low price target of $60 per share, which completely throws off our average. And to give you some context on this analyst, when it comes to Block, he has a 14% success rate over 58 ratings covering the stock, which is a lot and a very low success rate. So if we exclude that one rating and look at the 10 most recent analyst ratings with price targets, we will get an average 12-month price target of $100 per share, which would indicate a meager 10% uptick from current levels. Although for me, I'm a bit more bullish on the stock, but we'll have to wait and see how it all plays out. So there we just looked at 10 growth stocks. And I know this was a longer video, but I wanted to give you some context on why I like each of these components. Now, this doesn't mean rush out and buy all 10 of these stocks today. Make sure you perform your own due diligence and see which of these are good fits for your portfolio. Down in the comments section below, let me know Which stocks on this list today do you like for 2025? And if you don't like any of them, that's okay. You can put that there too. That's what makes a market a market. And if you haven't done so, please show your appreciation by clicking that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.